In this chapter, we're going to continue our study of negotiable instruments by looking at the bank-depositor relationships. So the relationship between the drawee bank and its customer is that of both a debtor and a creditor, and also an agent in principle. So a bank is any person who engages in the business of banking. That's the UCC definition. So if an institution is going to collect money from clients, provide clients with checking accounts, issue checkbooks to those clients for use with their accounts, identify clients by signature cards that the clients have voluntarily completed, sends customer statements about those accounts, and pays out money from those accounts based on the orders contained within checks that are made out by and signed by those clients, then that institution is a bank. The bank has some duties. First, the drawee bank is under a duty to honor all checks drawn by its customers when there are sufficient funds on deposit in the customer's account. If there are not sufficient funds, the bank can charge the customer's account even if it creates an overdraft. And if a bank fails to honor a check because of a mistake on its part, the bank is liable to the customer for any actual damages the customer suffers. The drawee bank has no liability to the holder of the check, though, unless it's a certified check, which remembers one that it agreed to honor. The bank also has some duties with a stale check. A stale check is a check that's presented for payment more than 6 months after its due date. So the bank is under no obligation to a customer to pay a stale check unless it's certified. And the drawee bank is not liable for the payment of a check before it has notice of the death or incompetence of the drawer. A bank doesn't have to pay, like we said, a stale check unless it's certified. And the bank isn't liable to a holder of a check for dishonoring the check unless it's certified, which we've already covered. The holder's recourse, though, is against the drawer or the endorsers on their secondary liability. So if the bank fails to pay, the holder of that check, if they're a bona fide holder of that check, they can go to anyone endorsing the check and request payment, or the drawer, which remember is the person who created the check. They can go to that person and request payment. The bank also has some duties with forgery and uttering. Forgery is a fraudulent making or alteration of a writing. So a forgery is committed when a person fraudulently writes or changes a check or other form of negotiable instrument and injures another. It's a crime, subject to fine and imprisonment. If a bank in good faith pays the altered amount of a check to a holder, it can deduct from the drawer's account only the amount of the check as it was originally written. And then uttering is the offering of a forged instrument to another person when the offeror knows it to be forged, and also a crime. All right, so we have some acts here about the availability of funds. First is the Competitive Banking Act. And the Federal Reserve Board of Governors issued Regulation CC, which requires banks to make funds available to depositors according to a prescribed schedule. So this is, you deposit a check with your bank, and they are required to post it within a certain schedule, within a certain number of business days. And a business day is defined as Monday through Friday, except for federal holidays. And then a banking day is any business day when the bank is open for substantially all of its banking activities. The midnight deadline is the midnight of the next banking day following the banking day on which it receives a relevant item. The depositor, the one putting the money in the bank, they also have duties. So depositors in general owe a duty to the banks in which they have checking accounts to have sufficient funds on deposit to cover checks that they write. They must also examine their bank statements and any canceled checks promptly and with reasonable care, and notify the bank of any issues with their account within a reasonable period of time. If someone writes a bad check, the payee has the obligation of informing the drawer of the non-payment of the check. So remember, the drawer would be the one who created the bad check. The payee is the one receiving payment. If the check is a bad check, then the payee must notify the drawer, together with notice of the provisions of the bad check law and of the party's legal rights and obligations. And then after receiving that notice of non-payment or dishonor, the drawer is given a specified number of days in which to make the check good without fear of prosecution. Most states have state statutes making it larceny or attempted larceny for a person to issue a check drawn on a bank where the person has insufficient funds. All right, like we've briefly mentioned in the overview, the UCC requires depositors to examine their bank statements and any canceled checks promptly and with reasonable care when they're received from the bank. All right, if the bank receives an antedated check, which is a check written and dated on one day and delivered at a later time, that's the definition of an antedated check. The bank can deposit or cash that as normal. A post-dated check is when the drawer delivers the check before its stated date. So I deliver it January, and it's January 15th, and the check is dated January 30th. A bank is allowed to charge a post-dated check against a customer's account unless the customer has notified the bank of the post-dated check. So it's not sufficient just to write a check and date it a later date. The bank can still deposit or cash it. The bank has a right of subrogation, and what that means is basically the bank can step into the shoes of any holder in due course, payee, or drawer who has rights against others in the underlying obligation. So if a bank fails to stop payment on a check, for example, it's responsible for any loss suffered by the drawer who ordered the payment stopped. But the bank can take the place of any holder in due course, payee, or drawer who has rights against others in the underlying obligation and try to recover from them. This right to be substituted for another is known as the right of subrogation, and it's designed to prevent loss to the bank and unjust enrichment to other parties. All right, so you've probably all heard of the FDIC, the Federal Deposit Insurance Corporation. They insure deposits in banks. So as you probably know, in the 20s when the banks failed, people lost all their money. There was a run on the bank, right? And people lost their money. Well, the FDIC now insures deposits to ensure that doesn't happen again. And that basic insurance coverage protects individual bank accounts up to $250,000 and joint accounts for up to an additional $100,000, so up to $350,000 on joint accounts. All right, so here this is showing you how a husband, wife, and one child may have insured accounts totaling $1 million of FDIC insurance. So these are individual accounts, and they can each have a balance of $100,000 and be insured. So this family now can have deposit insurance of up to $1 million. And here are the descriptions of the different banks that basically are in the life cycle of a check, the different banks that might touch and work on that check. So first, the depository bank. It's the first bank to which an item is transferred for collection. And the payer bank is a bank by which an item is payable as drawn or accepted. There's an intermediary bank, which is any bank to which an item is transferred in the course of collection, except the depository or payer bank, so the one in the middle. There's a collecting bank, which is any bank handling the item for collection except the payor bank. A presenting bank, which is the bank that presents an item except a payor bank. A remitting bank, any payor or intermediary bank remitting for an item. All right, and this next slide after this one is going to show you the life cycle of a check. And this is talking about an example in your book, but a person named Rubio, his check is traced through its collection and clearinghouse routes. And it is right here. So first, Rubio is in Oakland, California. He ordered a 37-inch plasma HD TV monitor from a company in Massachusetts. And she sent a check drawn on her Oakland bank along with the order. So she mails the check to the electronic company. The electronic company deposits the check in its account in the Massachusetts bank, which is the depository bank. Next, the bank transfers the check information electronically for credit in its account at the Federal Reserve Bank of Boston or directly to the Federal Reserve Bank of San Francisco. That's an intermediary bank. All right, then the Federal Reserve Bank of Boston transfers the check information electronically to the Federal Reserve Bank of San Francisco for collection, which is a collecting bank. Then the Federal Reserve Bank of San Francisco forwards a substitute check to Oakland Bank, which deducts it from Rubio's account. So Oakland Bank is the drawee and payor. And then that substitute check is returned to Rubio, and it's charged against the account in Oakland, California, and then payment is issued. The Federal Reserve Bank of San Francisco is the collecting bank, so payment is issued there. The Check 21 Act is what allowed for electronic clearing of the check. So before, in this example, the check would have to physically travel to all of these places. But because of the Check 21 Act, it brings the check clearing method into the modern age by the use of electronic check processing. It changed the requirement that original checks must be presented to the drawee bank for payment. A substitute check is used, which is obviously much quicker and much more convenient. That substitute check, which you've probably seen if you sign into your online banking account and you click on the check, you can see a copy of a check you've written and the back that it was endorsed. That substitute check contains an accurate image of the front and back of the check and is the legal equivalent of the original check. All right, like we just said, that substitute check is a paper reproduction of both sides of the check, and it can be processed like an original check. It's also called an image replacement document. All right, now moving on to consumer protection. So this right to expedited credit exists if the consumer asserts in good faith the following 4 facts. So if a consumer makes a claim within 45 days after receiving a bank statement or substitute check that there's an issue, a bank must investigate it and make any necessary recredit to the customer's account. If the bank needs more than 10 days, it must recredit the customer's account for an amount up to $2,500 when it completes its investigation. And the bank must recredit any remaining balance greater than $2,500 no later than 45 days after the consumer submits the claim. So again, the consumer asserts the following 4 facts. First, the bank charged the consumer's account for a substitute check that was given to the consumer. Either the check was not properly charged to the consumer's account, or the consumer has a warranty claim with respect to the substitute check. The consumer suffered a resulting loss, and the production of the original check or a better copy of the original check is necessary to determine the validity of any claim. So these issues become more common as we have mobile deposit and things like that, where I can just take a picture on my phone and deposit a check. That actually happened to me at my bank one time. I had written a check to someone and they had deposited it, and then a couple months later they deposited that same check again. They mobile deposited it again, and my bank did not catch it, and they took money out of my account twice. So of course I called, and they had to comply with these consumer protection rules while they investigated that issue. All right, now we are all very familiar with electronic fund transfers. People can go to ATM machines 24 hours a day and make deposits and withdrawals and pay bills by phone. They have their paychecks direct deposited. They pay for things online using e-checks. So this is, of course, electronic banking. We use consumer computers and electronic technology as a substitute for checks and other banking methods. These are also called electronic fund transfers. We use online debit cards to make an immediate transfer of money from a customer's bank account to the merchant's bank account. And we use offline debit cards, and we record a debit against the customer's bank account, which will be processed later. This is governed by the Electronic Funds Transfer Act. Regulation E was issued by the Federal Reserve Board under the Electronic Funds Transfer Act, and it establishes the basic rights, liabilities, and responsibilities of consumers who use electronic fund transfer services and financial institutions that offer these services. This act covers transactions including the following: point-of-sale purchases, automated teller machine transfers, telephone-initiated transfers requiring an entry password or a PIN number, transfers resulting from debit card transactions requiring an entry password or a PIN number, and internet banking. So as you can see, the law of negotiable instruments heavily involves this bank this bank relationship, this bank-consumer relationship, which is why there are lots of specific rules and regulations that apply in this arena.